would like to now introduce our distinguished panel. Alan Litt is president of Monticello Asset Management. Oh, by the way, we're going to be talking about bridge financing and how it's not as easy as it looks. Alan Litt is president of Monticello Asset Management, which has completed billions of bridge loans in the past few years. Ashish Shah is second over there, and he's the managing director of Formation, a bridge lender providing mortgage and mezzanine bridge loans for acquisitions and recaps. Josh Rosen on the end is senior vice president and managing director of Walker & Dunlop's FHA Finance Group. And Neil Gamss is senior VP at HHC Finance. Thank you. And in addition to HHC's regular HUD lending, Neil is also the co-lead of the Capital Advisory Group that specializes in placing bridge, mezz, pref, equity, and working capital loans with lenders and clients across the country. Since co-founding the group 4 years ago, they've closed over $2.5 billion in arranged loans. And I'd be glad to help you with your resume. That was a pretty extensive introduction there, Neil. So, okay, so our first thing we're going to do to make things a little more interesting, we promise not to bore you to death, is actually talk about some case studies. Bridge lending represents billions of dollars of financings. Typically, it's bridge to GSC, but typically bridge to HUD in the case of skilled nursing. So Josh, Alan, and Neil, I don't know which order you're going to go in, but go ahead and throw out some ideas on or not some ideas, but some examples of what you face and some of the challenges with bridge.
So my name is Alan Litt. Josh and I worked on a deal a few years ago in Massachusetts, and the deal was something that had to happen very quickly, but we saw a clear path to HUD. We saw that it was possible. The issue that we ran into as a bridge lender was that there was a couple of environmental situations in Massachusetts that occurred because of the historic nature of the site. So what Josh was brought in early by the client, which is always a good idea, and he actually was at the first meetings and participated through the entire bridge process and advised us as bridge lender on all the environmental and other related things that HUD was going to need. Now, during the bridge process, it took about 2 years to resolve many of these environmental issues. There was nothing wrong. It's just paperwork that needed to be done. And that's the kind of thing that we're seeing more and more of. Every site is complicated. Every site is difficult. HUD requires very complicated reports. And by bringing in Josh early at that particular point, we were able to really go through it and exit the bridge on time. I actually think it was a few months early because he was involved since day one. I mean, maybe Josh, you could talk about your...
Yeah, I mean, I echo those sentiments. I think, working with Alan was great on that, those transactions. But the biggest, I'd say, problem that can come up is during the bridge process. If you're not at the same time vetting the HUD potential roadblocks, you're making a mistake. Because the bridge lenders, obviously, the numbers are the numbers, and those are, certainly important. But just as important is, like Alan mentioned, certain environmental issues that the bridge lender may not have, or the bridge desk of a HUD shop may not notice. But then when you get to HUD, all of a sudden you're in a floodplain or something, and it's there's nothing you can do. Aside from environmental issues, there's also quality of care issues. SFF prospect list is a hot button right now. The SFF list, obviously, and just in general, quality of care is getting a lot more scrutiny at HUD than it ever did before. I think one of the one of the notes here in this panel is about a post-Rosewood HUD. So to that point, what Rosewood did in HUD's mind is, it's a 180. So anything that, potentially was sort of like a little gray area or not as heavily investigated, those days are long gone. So, if you're a one-star building, if you have survey issues, if the abuse tag is up, I mean, a bridge lender may not put the stop sign on you, but HUD, I don't want to say it's a non-starter, but it's a very, very difficult, comprehensive process to get those deals done today. In Illinois, obviously, but even outside Illinois, I mean, it's just quality of care is such a heavy focus now that it's really important to vet all that stuff. And it's not only that facility, it's if the umbrella company has a bunch of deals that are 1 stars or a SFF prospect list, even if your building is a 3 or 4 star, that doesn't necessarily mean what you think it means, because HUD's still going to look at the overall star rating of the group. So I think a lot of that stuff just needs to be vetted up front, which good bridge lenders will do.
And Josh, if someone does experience care issues in a building or one of several buildings are going through bridge to HUD, does HUD look at the trending in a positive direction, or are they pretty strict on?
Yeah, no, I mean, look, a lot of times you'll see buildings go from a 4-star to a 1-star like that, because the way the star rating works, right, you can kind of get hit from something that happened a while ago, and it drops it, like a rock. So, but I think HUD does, look at every, facility individually, and they will, listen to stories. I mean, I'm not trying to be, all negative here. They will listen to arguments. They will listen to the fact that they just had the annual came in, was clean, relatively clean. They may have had a complaint surveyor. I mean, there's always wiggle room there, but in general, 1 stars and even 2 stars, you're going to have to mitigate it. It's not enough to say the building is at 60% loan to value. That doesn't. I mean, that matters, but the star ratings and the quality of care and the overall quality of care in the company, in the parent company, that's really, really hot button right now.
Neil, what about your experience?
Yeah, so we're involved on the bridge side, arranging loans, and obviously on the HUD side as well with the takeouts. So we're working with lenders on the bridge side, and recently we had a deal that seemed like piece of cake. Numbers were stabilized, everything's ready to get to HUD. It should be able to get to HUD in 9 months, and in 8 months in the perfect world. And one thing that we're seeing and that we're insisting on with bridge lenders more often now is we're not into like 12-month terms on bridge loans. Even though things seem very simple, we want a minimum of 18, but really even 24 with extensions, because things pop up and things go wrong. So, for example, on this deal, it was a deal in New York City. It was a low LTV. The building was making a lot of money. It happened to have been a very large cash out, but at a very, with the bridge loan, but at a low LTV. We did HUD third-party reports, as Alan and Josh were saying, to make sure that there were no HUD issues. We do that up front very often. And there was an issue, an environmental issue that ended up taking a lot longer than we thought it would because of New York City and because of different regulation that they had over there. And things, thank God we have the commitment and everything went well, but it just took a lot longer, and we had to be extremely involved, both on the bridge side and once we brought it to HUD, with solving that issue, working with New York State, working with the environmental people as well. And it speaks to I think what's changing is really the term on bridge loans as well, is we're pushing for just to have more time, because things come up, most things can be worked through, but you need to have that flexibility.
Yeah, the cushion, and if the investor was expecting their money out in year 1 and they don't get it till you, they might be fairly upset. 100%. Okay, so we're going to move on to the next topic, which we're going to give Monticello and formation. So we're going to give Alan and Ashish a chance to talk about why go to them for the solution, the debt solution, the bridge, and then we're going to go to Josh and Neil on the other side, and why use them. In other words, these gentlemen all kind of specialize in certain areas of the bridge to HUD financing and different types of transactions. So first we're going to hear from Alan and Ashish. Whoever wants to go first.
Go ahead, Ashish.
Okay. Why use you guys over these guys and these guys over you guys? Like, what's the situation that calls for it?
We're wonderful people, and we're friendly and easy to work with, unlike other people on this panel. That was it.
That's it? Okay. Alan, what are you?
So I think that we're all wonderful people. I think that when you go to a bridge loan, very often there's a short time window that the seller wants to get the execution done. There are many banks that can clearly execute quickly and efficiently. But sometimes you just got to move at lightning speed, because the seller's afraid of what's going to happen at the building. Mm-hmm. They're afraid of deterioration. They're afraid of their nurses finding out and blowback at the building. So they're putting these incredibly crazy restrictions on closing and diligence. So people come to us when they need that ridiculous time frame, and they don't want to take syndication risk on a large deal. Mm-hmm. We're able to do transactions that are 10 million. To date, our largest transaction is 165 million, and we could do it all together, where they don't have to worry about, is the money going to be there, or am I talking to 10 people, or am I talking to 1? I think this is coming from the pressure from the sellers. The buyers are feeling that pressure. Banks that we compete against want to do these deals and are capable and understand the transaction in the space, but sometimes the requirements of the sellers are almost ridiculous. And so that sort of caused the creation of this finance company or FinCo to fill that gap and bridge until, like a lot of our loans, bridge to banks. They bridge to HUD. They bridge to other platforms that we might have.
Yeah, I would add one more thing, which is, I think coming from our backgrounds, I think what's very important with the timelines that you're describing and the pressure is that does your bridge lender think like you as the buyer, as your client? So all the pressures that you're facing, I think we've heard frustrations from clients where they've used other lenders and they don't put themselves in the minds or the shoes of the client with the pressure that they're facing and all the varying priorities and the challenges that they're facing during the acquisition process. And so are you as the lender putting yourself and thinking about all the problems that they have also? Now it's a two-way street. Is your client sharing? And this is something I would encourage borrowers to be very open about what is the story, because smart lenders, like the people on this panel, will find out. But if you tell us and there's issues that you're concerned about, I would always encourage you share that with your lender. And if they're a good lender, then what they're going to do is work with you and be aligned with you, because ultimately we all want to do deals with high quality people. And if you've got an issue and it can be solved and we can help you solve that problem, that's what we would always endeavor to do. So that's why I would add that to that, is that good bridge lenders are folks who are, especially in these acquisition situations, who are able to work with you and think about all the other problems, like some of the HUD issues that you're talking about, the environmental. Have you confronted that, and can you work with them to get to the finish line, which is 45 days out?
So Neil and Josh, why use you guys maybe in certain situations, aside from these guys, or instead of these gentlemen, or do you have like a specialty area? What would you tell folks?
I mean, again, I think everyone here is a really good, really smart lender. I think it's about relationships. I think it's got to be something where, one of the things that we're doing now is we're very active on the bridge side, on the mezz side. So we kind of look at it as, we're a relationship capital partner versus, being a HUD lender. There's a lot of HUD lenders out there, a lot of good HUD lenders out there. So I think that, one of the things that we try to do is, like everyone's been saying, figuring out, identifying potential risks, potential stumbling blocks. You're buying a building, there's a CD the bank wants, or, there's a sinking fund, or the deposit money, or how do you get that back when you go to HUD? So all these questions that, you tend not to think about until, you're ready for HUD because you don't really care about it. But those are the things that can trip you up, and, all of a sudden you got to redo all your debt documents, and you got to modify things and pay your lawyers, a lot of money to do that. So, we always try to set things up, with HUD in mind initially. Which can make a big difference both with time and with money when it comes to maximizing your dollars on the way out.
So yeah, what I would say is, I spend most of my day on the capital advisory group, which is really placing bridge loans or placing working capital loans. But I work very, very closely with our HUD group to ensure that everything that we're doing kind of fits with the game plan. And I think that that's important for both clients and also for lenders. So we work with many different lenders across the country, and we've done repeat business with both clients and lenders where they see that it works, where we'll do an acquisition loan and we'll get that HUD execution and kind of do it again. And we're there from the beginning of the process, which is at acquisition of the facility, often with a borrower or with a client that's buying their first building, and you find the right lender for that, but also working through with HUD. Obviously, like everybody said, I'm on the panel with great people here, and I've worked with everyone here actually. But what's important in choosing, I would say, someone who can place loans is someone who has that HUD perspective and that has the ability to find the problems before they're problems and kind of fix them in advance. But I would say more importantly on the HUD side as well, HUD is obviously you're working with the government and they have a box, and depending on who you're working with at HUD and what relationships you have at HUD, where you can frame things to fit into HUD's box that perhaps other HUD lenders that have less experience think they don't think it fits. Now HUD doesn't often change their box, but you could get creative and kind of fit it into their box. You're dealing with HUD people that are often contractors or employees at HUD they don't want to take risks. They don't have upside in taking a risk. The way that the client has an upside in getting their HUD loan done, and you have to have that ability to make them feel comfortable from your experiences with them in the past, and also with your, your ability to deal with problems up front and find solutions.
So we're kind of talking in and around this concept a little bit, but Josh and Neil in particular, can you explain how folks in the audience can use, and your clients can use the bridge to HUD process? Like, when is it good to use that instead of going directly to a bank or directly to HUD? And what is it about the process that allows the property or the transaction to be put in the best position to go to HUD as opposed to going right away? Because that's part of the reason people use it, right? Because it is a two-step process, but why
Sure,
use it?
yeah. So obviously HUD for the most part, unless you're doing an acquisition loan with HUD, which is very uncommon because it takes a long time. So usually when you're doing an acquisition loan, it's going to be with a bank or with a bridge lender, depending on where we place it. And so obviously for acquisitions, and then we'll do the HUD takeout after that. But often what we're seeing now is either clients that have owned facilities for a long time that are currently with HUD, that are under leveraged, that they want to take out of HUD with the intention of bringing it back in 2 years. So HUD's prepayment penalties after 6, 7, 8 years are a little bit, they're lower at that point. And there's a lot of loans that are with HUD that are currently under leveraged, and we've been doing that recently, where we're taking deals out of HUD, taking a bridge loan, even if it's not at 80% leverage, sometimes it's at 70% leverage, and the cash out that they're getting from the bridge lender is still significant, and bringing it back to HUD, depending on how high your leverage is, either with no wait time at all, directly back to HUD, or with a 1 year or 2 year seasoning period. We're doing a lot of that now.
Anything
Yeah, I mean, I would echo what Neil says. I think another point here is a lot of times I get the question of, well, if I'm buying a building at a below market, purchase price, right? Why can't I just, go to HUD and with a higher value and get my money out right away? So HUD is, many times not stupid. So a lot of, if you've been optioning a building and you've built up that equity through your operations and your option price is 10 million, but the building's worth 20 million, that's an easy sell because we can sell to HUD the fact that, it was worth 10 at the time you signed the option. Because of your operational strength, it's now worth 20, right? So that type of thing you can get the 10, and I'm just making up these numbers, but that increase in value with your equity that you've built in, that's usually okay. But if you're doing a regular third-party market sale or some other screwy type situation and you just happen to be getting a better price, right, then you need to spend some time in that building demonstrating that the value is what you paid for it, because just because if it values at 15, but you paid 10 for it, HUD's going to say, well, I don't care what it values at, it's worth what you paid for it, right? If it's a true market value sale, you can tell me all day long it's worth X, and it might be if you look at the numbers, but it's worth what someone's going to pay for, which is what you paid for. So I think a lot of times we see that some, 6 to 9 months is a general, range that we use to actually get in the building, start operating it, and even if you just continue the performance, I think that's a big, stumbling block that people sometimes don't think about is making sure, because everyone wants their equity back, but sometimes it's not as simple as just, bridging in and then going immediately to HUD. There is oftentimes a need to kind of, get in there, operate it, prove some trends over a few months, and then start the HUD process.
Go ahead.
One of the other points that we've seen in the bridge is that sometimes this is an operational issue. So you're taking over a building, it's not been operating properly. Now you step in and buy the building with a bridge from a bank or from a finance company. And one of the things these guys really need help with is you're ramping up in your new numbers, you're putting your management in place, you're doing what you do. But if there is a glitch along the way, you need to really document that glitch, because these guys need help in explaining, even if it's a 1 month or a 2 month, could set you back literally a year. Because then you got to restart the clock all over again. It might have been something very simple. You were renovating, you took rooms offline to renovate. Being able to document some of these things will make these guys get it through.
I would add one more point to that. It's not only about the HUD, but also your current lender. So when you do have a blip, again, we see the financials after you send it. What we rather not do is the corollary requirement is 45 days later. If you are having a blip and if it's real time, we strongly encourage you, because lenders are looking at the people on the panel, we will be very friendly to glitches as you're telling them and telling us your plan. If we find out after the fact, that typically is a conversation that goes a very different way. So, highly recommend that if there is a glitch, which invariably happens, talk to your lender and keep them informed. And if you keep them informed, they're going to do right by you.
So sticking with that subject, but being a little more specific, if you can think of anything, Alan, what are the key components of preparing to obtain a bridge loan for an acquisition, and what are some of the primary obstacles that you've seen that must be addressed prior to the financing? And then you're going to handle it on acquisitions, and then Ashish, if you could handle that question for refis.
So in the acquisitions, it's a matter of data gathering. We have a system where we help the client gather data efficiently. But what happens is if the clients don't give us the data quickly enough, it causes delays. And that gets everybody upset, gets the seller upset, and gets the buyer upset. So the key thing is to come up with a launch at the initial term sheet signing that enables everybody to understand what their roles and responsibilities are, and then try and efficiently gather the data to do that. No one's perfect. Everybody makes mistakes. But at the end of the day, that data is what's driving the schedule and what drives a successful bridge. I think what Ashish said about when you're operating the building, also when we're doing the acquisition financing, if there's something bad that you did or something bad that we're going to find out about, it's better to tell us in advance so that we can manage the process or decide not to do it versus us finding out about it in the due diligence process. Because we've done loans where people have had issues in 08 and 09, and it's a terrible part of our economy. But we were able to manage it because we were ahead of it, like what Ashish said on the back end. So it's data gathering, it's being efficient, communicating, and sort of being understanding that nobody's perfect. And we all make mistakes, and we just got to try and get it together.
Yep, I couldn't agree more with it, because, I mean, invariably, smart lenders will find out. I think on the recap side, in fact, there was we had a number of conversations over the last 24 hours talking about doing recaps. And in our history, if I look at the deals we've done over the last 10 years, interestingly enough, only about half of the loans that we've originated have actually gone to HUD. The other have been split between refinancing or sales. So HUD's not the only thing, but HUD's a good guide, and the constraints and discipline around it are a good guide for whatever option that you ultimately decide. I think on the recap, the most important thing for us is, no differently than applying for HUD, is how do you believe that you've created the value, and how do you believe the value is stabilized? So, you know, the conversations are going to be about not only the track record and understanding the bridge of the value increase from when you took over a property to where you are today, but presenting a story saying, hey, this is how you should get comfortable that, hey, we've doubled the value of this property, and this is a sustainable level, and it's not some accounting gimmick, as an example, that, hey, look, we've driven census to a certain level, and this is because of all this marketing effort that we did. Oh, and then we also built a new rehab gym, and therefore we're getting our disproportionate share of QMIGs. And so this is the part of the story that we want to hear from you, and being backed up by numbers. And again, you should be well prepared because you've been in this property, and you know this property better than anybody else compared to when you're in acquisition where you might have very little contact with the property. So I think the proof of stability and of your operations is the most important thing, and all the supporting data and story that goes along with it.
So Neil, what are the typical costs for obtaining a bridge financing, and then the HUD costs as well, and how does a borrower manage those costs to keep them?
So on the bridge side, the costs are, you know, it's pretty similar with whichever lender you go with. You're going to pay a lender origination fee often. You're going to pay for your legal. You're going to pay for lender legal as well. Obviously, the number of comments that are going back and forth and how difficult, I would say, each lawyer is will definitely impact the cost.
Lawyers are never difficult, are they?
What was that?
Lawyers are never difficult.
Yeah, no. And it's obviously as upfront that you could be with issues, you know, similar to what Alan and Ashish were saying before, but issues that are going to happen during closing, if you're upfront about it, it gives the lawyers the ability to deal with it upfront rather than finding out about it and redoing documents over and over again, which we've had, unfortunately, sometimes. So, and that obviously, the costs build up from there also. You're going to have third-party reports, which is standard wherever you go. I would say that, you know, on the bridge side, ways that you could try to control costs on title recording, maybe, if you want to assume a mortgage, which we've done with HUD loans as well. HUD loans, you know, those mortgages can be assumed. And I would say if you have recent third-party reports, I guess, that can be refreshed and used, you can control that.
Yeah, okay.
So one of the things that we've been tracking recently is the legal bills. And the clients get very upset, rightfully so, when the legal bills get very expensive. And the client's running the building, and their main focus should be to run the building and take care of the patients. So the lawyers very often, not that they're bad, are just going along, negotiating with the other side, the bank, and there's this back and forth volley that occurs, and then the bill comes at the end, and everybody's angry. The client's angry, the lawyer gets yelled at, everybody's angry. I just have recently tried where we're trying to get clients to be more involved on the legal calls, to gather a more formal note-taking process so that we're going back and forth a few times, as Neil said, not a lot of times.
Right.
And we're seeing some benefit from that over and over and over again with the legal bills coming down. The other thing is we're requiring our lawyers, if it's a follow-on transaction, to pull the latest set of documents, and that's the starting point. If we negotiated it once, that's it, we're done. Let's not go back and renegotiate it. The big number now is the legal. At $1,000 an hour for a partner and all the other costs that go in, they have to do their job, and we get that. We're trying to work with the lawyers on both sides to be more efficient. That's the big cost.
Yeah, I would add one more thing, and I couldn't agree with more what Alan said, because I think the reusability of documents is a huge way to be efficient. We are encouraging our clients to be much more proactive in the legal process, and if there is a business issue, to bring it up to the business side versus having the lawyer solve it. And I can't stress enough, having a good legal team that you're overseeing as your job as a client is really important, because where we've seen that disconnect is the client is uninvolved in the legal process, and it's that ping pong effect that happens. And look, a good lender will try to stop that. We'll be in regular communication with our lawyers and trying to figure out, hey, is there a business issue that needs to be addressed that lawyers really shouldn't be? Because lawyers should be documenting, not solving. And so we strongly encourage our clients to stay involved, because to the example earlier, nobody wants on the day of closing, hey, why is the legal bill so high? I want discount it or whatever, and it's hours before closing. And that's just a very difficult conversation for everyone, including the client.
Do you find that even if you haven't worked with a borrower before, but you're dealing with a borrower legal team and your legal team that have worked together before on other transactions?
So I would say that there's a few lawyers that, not more than, there's probably several lawyers who are at this conference who we've worked with, all of them, a number of times, and that makes the process go incredibly easy. Now, this is not to suggest that, hey, if you're a new client to ours, please use lawyers 1 through 5, but it certainly helps that's a lawyer that's in our industry, that has worked with us before, or worked with other qualified lenders. That does make that process go a lot smoother, because they've dealt with clients who, look, at the end of the day, the best clients, they're really good at operations, and acquisitions or recaps is something that happens once in a while. That's not their core skill set. So having a lawyer that understands that and is proactive about, look, this is a business issue, go talk to your lender, as opposed to having me solve it. They can, and look, they're really experienced and they're smart and all that, but it's not really their job.
We did a 16-building loan for an acquisition, and the title company survey and zoning reports came in, and they just shipped it to our lawyer. They were all wrong, had to be redone, and then they went around 2 or 3 times instead of the buyer's lawyer checking his work. So now we have a process where we're telling them, please tell us that you've reviewed this and that you think it's accurate. Again, everybody's human, we all make mistakes. But to double check the work before we get it, to try and keep the cost down. The title and survey and zoning guys just send it in, and they just send it over to the bank. And the problem is it goes around and around and around as a big bill. On larger transactions, we're now starting also a process where every 2 weeks, we're starting to give them an indicative legal number along the way. So we don't, as Neil said, come to the end, or as she said, and then there's this bill at the end and everybody gets angry. Because it's just out of our control. We don't make a profit on the legal, but the legal has to do what's necessary to protect the regulatory and compliance. So doing that and just trying to stay more organized. And as she said, getting the client involved, it does take them away from operating the building, but it does save a lot of money.
It's kind of like building an automobile and checking it along the way when you put the engine in, when you put the seats, whatever, instead of building it and then at the end you check it and then you got to take it all apart. Yeah.
I will say the one example that for clients who've done this now several times, that the combination of that legal team and the client, where we all agreed, so the lending side as well as the client side have agreed that the counsel of the borrower is quarterbacking the deal, quarterbacking the process. That is a very successful way to run an acquisition process. And now you've got to trust that person and can run it, but what you typically find is they can see the whole picture, not just one part of it, because they're also dealing with the seller. And so somebody who can feel good about having their counsel quarterbacking and pushing everybody, and oftentimes they might have a cheaper cost structure, that's a very successful way to potentially do things.
So Neil and Josh, talk a little bit about the cost for the client when they go from the bridge to the HUD.
I mean,
Why are the HUD fees so high?
In process.
I mean, HUD costs are, pretty typical. I think that, there is some economies of scale if you, if you're going to go from bridge to HUD right away, get, the HUD third-party reports so you can use those. A lot of legal work can be duped. There's certain things you can do to kind of save dual costs for a bridge and for HUD, but you're going to have two legal bills, at some point. I think that, where we get involved more on the HUD cost side is when it comes to replacement reserves and some of those numbers that you can have a little wiggle room with. So, whether it's part of the initial deposit or part of the ongoing escrow. So that's I think where we really see a lot more pushback and a lot more of our involvement when it comes to that. It's not so much on the. I mean, HUD is what it is. It's an expensive loan. There's a lot of costs and fees you're not going to have at a bank. But generally, what you're getting with the loan is worth those extra costs, which is why people put up with it.
Yeah, no, and HUD legal fees are usually much more contained, because you're kind of, there's fewer things to negotiate, that's for sure. You're working through a system that the lawyers have done many times before. I would say the legal on the bridge side is much more, it's a wider range, that's for sure.
We've seen a trend also on the bridge with the cost. It used to be that people would figure 1 to 1.5% soft cost to close the loan. You have an origination fee, you have some legal, you have title and so on. State fees have increased for transaction costs. We're now seeing statistically it's like 3%. So when you're buying a building, it's a real number now.
Yeah.
And some of that is manageable by you as the client, and some of it is the states now are figuring out, let's do mortgage recording tax, let's raise the tax. Maryland's is a good example. They charge a huge number to create the transaction. New York State, huge number for mortgage recording tax. So the lawyer who's representing the client should be sitting with the client and making sure they understand all these costs that are on top of the purchase price.
Yeah, well, rich people should pay more taxes, for sure.
That wasn't what I was saying.
No, just kidding. All right, I don't know I think we have about 5 or 10 minutes left. Any questions for the audience, for the panel?
Somebody address the HUD master release process and what triggers that?
I mean, it's triggered by 3 buildings or $15 million, either or, as that's sort of where it gets, or you're required to do it. Now, a lot of times, you'll see there's not if the ownership is not exact, but it's close, and there are certain minority investors that don't want to be tied to other people. There are ways, there's cash flow pledges and certain things you can do aside from having a master lease. So it doesn't necessarily automatically qualify you for a master lease. Again, that's really only when there's, very, very, similar, if not exact ownership in different buildings. And that goes in the PropCo or the OpCo. And then, again, that's what we generally try to do is set up the master lease with the first building, even though we know the other one hasn't come yet, because that saves legal bills at the end of the day when you're adding the second, third, and fourth and onward. But the 3 buildings or $15 million is the technical HUD requirement as per the guide.
Any other questions?
We're so interesting. Yes, Tammy. Yay, Tammy.
Can you talk a little about, you mentioned before the star ratings, and it's more of a, I guess, quality loan for might be a decent rating, but maybe the portfolio as a whole.
Yeah, I mean, if
Let me just repeat the question. I don't know
oh.
if everybody could hear the question. So the question addressed or was talking toward the star ratings and like if you have one facility that's poor within a portfolio or something. Was that the question?
Yeah, I mean, again, it's always better to bring a 4 or 5 star building, as you know, so that's, I just want to put that up front. But if you have a 4-star building and the rest of and you have 12 buildings and they're all 1s and 2s, and this lender's bringing the 4, you're going to have to explain that, right? I mean, it's not just enough to have the 4-star and hope HUD doesn't look into the other buildings. They will. They use Google. They're very well versed in technology, so surprisingly. So, a lot of times you'll have to, the lender will, write up kind of a global look at the operations. And it's, yeah, I mean, obviously this building is great, but if there's a bunch of 1s and 2s, HUD's concern is going to be, well, how do we know this isn't going to go to 1 or 2, with one bad survey or one big complaint survey, or, things can change on a dime. So I think the biggest factor, in my opinion, today at HUD is quality of care. Absolutely. There's nothing that comes close. Even financial performance, I mean, again, these are all obviously important benchmarks, but when it comes to quality of care, star ratings, surveys, quality measures, you got to be real careful. And this SFF prospect list that just recently became unveiled is another huge hot button at HUD. So if any building is on that list, it's a non-starter. Even if you have other buildings on the list, this building is not, but you're bringing a HUD, you're going to have to address it. You have to talk about it. You have to be very clear with the lender, and the lender has to be very clear with HUD as to the steps taken to get off that list or improve the quality of care overall.
And Alan's going to answer the question. Oh, go ahead, Ashish.
Historically, have you been allowed to include insurance or have equity holdbacks from going to HUD and lower rated facilities? Is that really no longer the case?
Well, we're seeing a lot of HUD requiring like third-party risk management, which usually can mitigate a star rating issue unless there's something extremely alarming that happened. And we're also seeing at times when things are pretty extreme that HUD will require, whether it's a 3 or 6 month debt service reserve, and that's usually able to make them comfortable. Not in the case of the special focus candidate list, though. I think that's kind of a no-go. But with 1-star buildings, that type of thing, they're also bringing up now, which they're this new abuse thing that's on CMS, which nobody really seems to understand so well.
The red hand.
The red hand.
So that also can be mitigated with third-party risk management. We see that.
I would translate to, for the bridge lending version of that same question is, we're absolutely looking at somebody's quality track record. So have they gone into a property and improved the property? And so it's not the CMS, it's a 1-star, 2-star, but we're also looking at the quality measures because there's some subjectiveness to it. And look, somebody can overstaff a building and get a 3, and somebody can staff it at an efficient level and also get a 3. So that's part of the story. And so I think part of what we've seen is we've looked at any number of 1-star facilities that, because look, there's a reason somebody's selling. They're not performing well, not investing in the business, and it's a 1-star. And I think there's a lot of lenders that would automatically say, oh, you want to buy a 1-star facility? I'm not touching that. And I think a bridge lender who understands the space is going to say, look, that's fine, but that's somebody else's history, and it's not your history. So the question is, does your history, is there something in your track record, the way you think about it, your team, can they come in and improve the performance there? And that's part of the underwriting that we do. It's hard to translate that specifically into a financial performance. It's, hey, if you come in, that's going to be $3 million of EBITDA. It's not something like that. For us, it's about risk mitigation. And so if somebody who has gone in and taken a 1-star to a 2-star, 3-star over a number of years, that's a great story for us. And for us, it's not about financial measures, but it's about, hey, do we put ourselves in jeopardy? Our surveyors coming in, is there an incident? And this is about being able to mitigate that concern.
So 1 second for Tammy. We built this system so we could look at an operator and it pulls up their star ratings on all of their buildings. So when we're looking at operator X, we literally can look at all their ratings across all their buildings, so we have all the data now mined. But then it also shows their competitors right around, because sometimes there are states where they outsource the surveyors, and the surveyors are violent. And I think it's the only way to explain it. Like you go to Kansas, they hand out IJs like it's candy. And so the key is we have to tell a story. What we're doing is we're in the bond business, so we have to tell the story. And the story is like as she said, what happened to this building? But our guy, what happened with our guy? How was he done? How was he improved? And by bringing all that data, we can go to our committee and explain their complete story, not just what happened here. So that's very helpful to us.
Sometimes we get pushback as a bridge lender on reporting, and, they always say HUD doesn't require that level of reporting. We tend to estimate it, sometimes review depending on, but I was told, and I'm curious how, if it's actually the case, is it only just the PropCo, because obviously the borrower is the PropCo,
Yeah, HUD doesn't require.
The question is, what does HUD require for statements, either audited or reviewed, and for the PropCo or OpCo or both? Statement quality?
Yeah, the audit's only on the PropCo side for HUD. Not for audited numbers, no, on the OpCo side.
But I think there's a difference. When we're doing a bridge, we're at risk. And we really want to know that someone else besides us is looking at this and double checking the numbers. So when we get that pushback, we have to have a conversation. Because if you're just doing internal financials, it's not very comforting.
One more quick question? Okay, well, I'd like to thank our distinguished panelists today and for the opportunity to do this. Thank you very much.
Panel before lunch. The panel before lunch.